Hello, everyone. I welcome you all to FinTedu's webinar on corporate tax and real estate profits. For today's webinar, we have Dr. Peter Wilson with us, who is a tax advisor with over 40 years of experience. Dr. Peter Wilson, over to you, please.
Thank you very much, Anu, and welcome everybody to this webinar on corporate tax and real estate. It's a very interesting subject and a very difficult subject. Part difficult because the law is new, part difficult because the law is very brief, and part difficult because the concepts are quite novel. But in this session, we'll do our best to introduce you all to the concepts, or the more important concepts. And Anu has reminded me that in a couple of weeks' time, we're going to have a face-to-face session in Dubai on this same topic. And in that face-to-face session, we're going to have many examples. So the presentation today has got a couple of examples in it that are taken from the FTA guide. But when we meet in a couple of weeks' time, we'll have probably 10 or 15 worked examples. And maybe at the end of the session, we can have a short comprehension test as well. I always enjoy the comprehension tests when I set them, not so much when I have to sit them. Any case, let's have a go at this. So this is me, and you're most welcome to learn more about me if you want. I think Anu will probably share the presentation with you later on, so you can read all this stuff. So here's the contents for today. There's a big divide, of course, between the tax for a natural person and the tax position for a company or a partnership or a foundation or a trust. And we know that whilst the tax law is supposed to be about corporation tax, it's really about the taxation of corporate profits and other profits that they want to tax. So these are the 7 major areas that I'm going to be lightly touching today. Obviously can't touch them in a great amount of detail. So we'll move on to the first one. Well, the first one really is just saying that we're going to be touching on income from property. And for this purpose, we're just going to be talking about net rentals and gains. There can be more complex forms of revenue from property, whether it's from a derivative or a loan or something like that. But in this presentation, I'm focusing on if somebody owns property and they get rental, how is that rental taxed? Or if somebody owns property and they sell it and they make a profit, how is that profit going to be taxed? Or is that profit going to be taxed? So firstly, we're going to start with the position for natural persons, and we're going to end up with real estate investment trusts. So here we go. All right, so what's the core rule? Now, we can all read what the core rule is, but basically it's saying that for a natural person, if a natural person's activity in real estate is something that falls within, pardon me, the meaning of real estate investment activity, and it's not a business nor a business activity, then it's not going to be liable to corporation tax. That's the fundamental core rule for natural persons. So is the natural person deriving income from something that is a real estate investment activity, and providing it's not a business or a business activity, then it's not going to be liable to corporate income tax. So the first 2 things that we've noticed from that is that for it not to be liable to corporate income tax, it's got to be a real estate investment activity, and it can't be a business or a business activity. They're the first 2 tests that we've got to focus on. Now, let's look at what is meant by a business or a business activity. These terms are defined in a number of places in the corporate income tax law and in some of the ministerial statements and the cabinet decisions. I think the same definitions are used in the VAT law. But basically, a business is something that we would all assume to be a business. It's an activity that's carried on regularly, frequently by a person that has an infrastructure and that the person looks like they're doing this in a business-like manner. That's basically what it is. And a business activity is an activity within within a business. So you can have an activity that's a one-off transaction that is conducted in a business-like manner, and that will be a business. So for example, if you have a natural person that buys one property, owns the property for 10 years, collects rent, and sells the property at the end of 10 years, that's not a business. It doesn't look like a business. It doesn't smell like a business. And that can't be a business activity as well. So that's the core rule there. What's a real estate investment activity? Well, one of the cabinet decisions actually defines real estate investment activity, and it's very important because, and I'll read it out, and it says any investment activity is a real estate activity if conducted by a natural person related directly or indirectly to the sale, leasing, subleasing, and or renting of land or real estate property in the UAE that is not conducted nor requires to be conducted through a license or from a licensing authority. So the first thing to notice about this is that an investment activity is a real estate investment activity. So if an activity is not an investment, if it's a trade, then by definition, it can't be a real estate investment activity. So that's the first thing to notice, that a lot of people and a lot of comments that I read seem to give a very wide coverage of real estate being tax-free. I quite regularly read, well, there's no tax in the UAE on real estate income or gains. That's right, but only if the person who is conducting the activity is conducting them as an investment activity. If the person's not conducting them as an investment activity, unfortunately, that widespread belief is not true. Not true. So, and you can see that the real estate investment activity covers the sale, leasing, subletting, and or renting of land or real estate property in the UAE. And let's put aside for the moment that is not conducted nor requires to be conducted through a license from a licensing authority. And when I raised the licensing issue recently with the Chief Executive Officer of Innovation Experts, the real estate training guide, the CEO told me that he didn't believe that any natural person was ever required to have a license from a licensing authority to conduct real estate transactions. I was a bit surprised by that. But you can see that if you're deriving rental, that should fit very nicely into the definition of an investment activity because that is a lease. If you're deriving a gain from the sale of a property, that should fall very nicely into the sale. So our prime two areas of activity for our discussion today, rentals and gains, should fall very nicely into the real estate investment activity exemption, as long as as long as the natural person is actually carrying on an investment activity and not a trade. So the next point that I want to bring out, because we've recently seen the Federal Tax Authority send a rocket around everybody who hasn't yet applied for a registration for corporate income tax. They've said that it said that a natural person conducting a real estate investment activity is not required to register for corporate income tax. So very clearly, the person who's got one rental apartment in Sharjah and they're renting it out and they're getting 10,000 dirhams a month, for example, and they make a gain of 500,000 dirhams when they sell it, very clearly they don't have to register for corporate tax. But if the natural person is not carrying on an investment activity, but is carrying on a trading activity, then it's not so clear. And people who are carrying on a trading activity might be very well advised to get some advice on whether or not they should register their trading activities for corporate tax, their property activities for corporate tax. So let's talk about what happens if it's not an investment activity. Okay, so here let's assume that the person has got 10, 20 properties. I recently, as strange as this may sound, about a month ago, a gentleman came to me who told me that he'd sold 2 billion dirhams worth of property in the UAE last year. This was a natural person, and he asked me whether I thought if his activities carried on in 2024 like that, would he be liable to corporate income tax? So it's very difficult to conclude that a person who made turnover of 2 billion dirhams is carrying on an investment activity. Very difficult. But so if the person's not carrying on an investment activity, then he or she is going to be required to register for corporate tax and pay corporate tax on the taxable profits. But the first question is, will that person end up paying any corporate tax? Well, we know firstly that there is the 1 million threshold in the Gregorian calendar year. So if the person is carrying on is not carrying on an investment activity, they're carrying on a trade. But if the person's turnover does not exceed 1 million dirhams, then they shouldn't be liable to corporate income tax. Now, I suspect that somebody who's carrying on a trading activity is unlikely to have a turnover that's less than 1 million dirhams. But, you know, it could be possible. They might have 10 apartments, each of which is rented out for 90,000 dirhams a year. That's 900,000. And they may not have sold an apartment in that year. So the turnover comes less than 1 million dirhams. So it's a possibility. The first thing to look out for, even though a person would be required to register for corporate tax, there may not be a tax liability. So that's the first thing. That's the first point that we need to consider, the turnover test. Now, the next question that we have to look at is, how do we determine whether somebody's activity is a business or a business activity? I mentioned previously that if somebody's got one apartment, renting it out, it would be almost inconceivable that that wouldn't be a real estate investment activity. But the FTA has written into the corporate income tax guide a definition of what it believes is meant by activity or business. And I'll read it out because we should focus on it. And it says a business is defined as any economic activity, whether continuous or for a set period of time, conducted by any person. So it's got to be an economic activity, and it has to be continuous or for a set period of time. So continuous means ongoing. So it can't be for a short period. And it's implied in all this that the activity has got to be conducted with the intention of generating a profit. And it's also contended that there's got to be a system and an organisation that needs to exist for the activity to be conducted. So if our person sitting in Dubai with the one apartment in Sharjah has got a full-time job and just watches the rent coming into her bank account monthly, that's probably not going to be a system or an organisation. But if our person has got 10 apartments and has employed an agent, and our person has an office, and our person has financed the apartments part with their own money and part with somebody else's money, then we're looking at something whereby the person may well have a system and an organisation. So the first issues that we really need to focus on is how does the person go about organising their property portfolio. So potentially at risk real estate fact patterns could be, firstly, the obvious one, turnover exceeding $1 million dirhams. The second one would be ownership of multiple properties, with many or most of which being held for the short term. So there's no definition of long-term, short-term, of course, in the real estate investment definition, but we know that in the free zone, and one of the free zone ministerial decisions, where we're talking about what constitutes investment and what doesn't constitute investment, there's the expression that if an investment is held for 12 months or more, it will be deemed to be an investment rather than a short-term holding. So if we picked up that period, if we picked up that term of 12 months, if our friend owning the 10 apartments is holding all the apartments for only 6 months and selling, that's probably a short term. But if our friend is holding all of them for more than 12 months, it's probably not a short term. Where we get into complexities, of course, would be if some of the properties are held for less than 12 months and some of them are held for more than 12 months. And that might give us a clue as to where our friend with the 10 properties might need to organise himself. So also what's likely to be a problem is property flipping. Now, we see a lot of that these days in people buying off the plan and flipping before the second and third payment needs to be made. That's going to be at risk. That's not likely, in my view, to be a real estate investment. Property flipping to me is more like a business activity, not a real estate investment activity. Also, what's likely to be on the cusp of an issue is if you're purchasing, renovating, and resale of multiple properties. I've recently had a number of people coming to me who are saying, well, they're looking at business opportunities of buying some villas on the Palm, renovating the villas and reselling them. And they've said that there's a lot of profit to be made on that. To me, that is not a real estate investment activity. That is a real estate trade, a business. That is going to be a problem. Also, what's likely to be a problem is where a person has established an infrastructure, such as office personnel, third-party financial leverage, perhaps at a ratio greater than 1 part debt and 1 part equity. So that's likely to be a problem as well. Having a plan where the owner intends to buy, sell, renovate, and uses third-party finance is also a problem. So with those little 6 or 7 examples, I'm trying to show you that all's not pleasant and simple here in the Garden of Eden or the Garden of Palm Jumeirah, that there's potential areas where people will have to or will fall outside real estate investment. And if they fall outside real estate investment and don't register for corporate income tax, they're going to get a penalty for not registering, and then they're going to get a penalty for not filing their tax return, and they're going to get a penalty for paying late. So this example number 14 is one that I've taken directly out of the Corporate Tax Guide, and it talks about a natural person, Mr. M, based in the UAE, sells his residential apartment for $2.5 million. And it says that the property increased in value by $500,000 since Mr. M bought the apartment. The guide says that the income derived by Mr. M due to the sale of the apartment is not subject to corporate tax, as he was not required to obtain a license to execute the sale. Well, it's the more I look at this example, the more I wonder whether the persons who wrote this example in the guide really understand the law, because they're saying here it's not taxable because he didn't require a license to execute the sale. Well, having a license to execute the sale is irrelevant. He would need to have a license to carry on an activity. And the sale would just be an incident in the activity. But the real test here is not really whether he has a license to execute the sale, but whether what he conducted is a real estate investment activity and whether it's not a business or a business activity. So one apartment making a profit can't possibly be a business or a business activity by itself, unless the gentleman had many more apartments than this one apartment. But I think the underlying principle that the FTA is trying to get across makes sense, but I think that their example is quite poorly written. And of course, that's not to criticize the FTA, because I think they're doing a good job. But I think that they are just struggling with the volume of information that they have to come to terms with. Now, this is another one, example number 15 from the same guide. So this one says that Mrs. N, based in the UAE, owns several properties located in the UAE and rents them for 1.2 million dirhams a year. Now, what they're saying is the guide says, as long as that activity is not required to be conducted through a license from a licensing authority, the income derived by Mrs. N is not subject to corporate tax. And they're saying that this is because it's a real estate investment and not a business. Before I move on to companies, I just want to summarize natural persons. So natural persons, the cabinet decision says that if a natural person is carrying on a real estate investment activity that is not a business or a business activity that requires a license to conduct, then the gain won't be taxable. So that sounds fine. But firstly, we need to drill down into what is meant by real estate investment activity. And we also need to drill down into what is meant by a business or a business activity that requires a license. And we know that the main corporation tax guide gives some indication of what the Federal Tax Authority thinks might be meant by investment or business. And it's very similar to the concept that exists in maybe 10 countries around the world of the badges of trade, the factors that indicate whether what you're doing is an investment or is not an investment. So for those people who are buying and selling, buying off the plan, flipping, buying with a large amount of debt, that have an infrastructure, that have an infrastructure that infrastructure that is designed to enable them to make a profit, they are going to be taxable. For those people that finance their real estate with their own money, they're just sitting on the properties for at least 12 months, ideally a bit longer, then they're going to be, in all probability, exempt from corporate tax. What about the companies? Well, companies, unfortunately, if they're buying and selling, holding real estate, they're just going to be taxed like any other company. They're going to be liable to the threshold, the 375,000. Unfortunately, the real estate investment rule won't apply to a company, because the real estate investment rule only applies to a natural person. It's highly unlikely that if the company is a free zone company, that the activity will qualify for the company will qualify for 0% corporate income tax. And I've set out some of the issues there. Is the client a free zone entity? Is it used for residential purposes? Does it have substance in the free zone? It's to be able to get 0% on the rental income and the corporate gain, and the gain is really threading through the eye of a needle. I do have one client that's got a DIFC company, and that owns 2 buildings, or a number of floors and a number of buildings in the DIFC, and its clients that it rents them to DIFC entities. So in that situation, there are office floors. In all probability, they will qualify for the 0%. But there are not many situations like that. And there will be people that will be trying to organise themselves so they do qualify. But I'm afraid that they might face the problem of Article 50, the anti-avoidance rule. So let's just speed through that one a little bit. Small business relief, yeah, company will qualify for the small business relief, won't it? If it's carrying on real estate activity, the 3 million dirhams should be doable. If we're just talking about rental, you could probably own 10, 15 apartments, earning 100, 150,000 a year in rent, and qualify for the small business relief. But as soon as you sell one of the properties, you'll probably breach that threshold. So you might see a lot of people who own 15, 20 apartments not selling them until after the end of 2026, just so that they can fall within the 3 million threshold. Calculating the company's real estate profits. Not really significantly different than calculating any company's taxable profits. You're going to start with the IFRS book profits, and then you're going to make any adjustments. And some of the adjustments I put down there are unrealized gains and losses, exempt income, and all those sorts of things. transactions with related parties. What I want to focus on, though, is not so much the revenue recognition adjustments and the accrual adjustments, but I want to focus on the transitional issues. So we know that there are transitional rules for companies that deal with unrealized gains in the companies at the time of the first tax period. And let's keep it simple. I'm a simple person. Let's assume every taxpayer is on a December year end. So let's assume that let's assume we're talking about January the 1st. So in relation to immovable property, you can make an election on each individual unit of immovable property. So if a company has 10 apartments, for example, it can elect on all of those, or it can elect on none of them, or it can elect on some of them, and it will make an election. It'll make an election in the circumstances in which there's a fair amount of profit accrued before January the 1st, 2024, and a little bit accrued afterwards. It probably won't make an election if the value of the property has gone down since January the 1st, 2024, but there was profit before that period. So it's going to be very interesting to think about when you should make an election with respect to units of immovable property. But the point that really needs to be borne in mind here is that for units of immovable property, it's not an election once and for all properties. It's done on a property by property basis, which is different in relation to financial gains and liabilities. And we know that somebody could be financing their property purchase with a foreign currency instrument. So if they've financed their property with a foreign currency instrument, and if you want to make an election to remove unrealized gain on the instrument as at January the 1st, 2024, you've got to make that election with respect to all your instruments. So let's say you had 5 financial instruments, 4 had a gain at December 2023, and 1 had a loss at December 2023. You can't just make the election on the 3 gain ones and leave the loss one not elected so you can get a benefit of the prior loss. You've got to make the election on all of them, which is a bit of a nuisance. Partnerships and real estate. The core rule here, and I apologise, I'm having to speed up a bit because I know everybody's got to get off to where they're going, and I will stop in a few minutes so you can ask me questions. But if the partnership is an unincorporated partnership, then the partnership is treated as if the individual partners are carrying on the real estate business rather than the entity itself, the partnership. So if we had 3 individuals all carrying on, all partners in an unincorporated partnership, then presumably that partnership could have a turnover of up to 3 million, then because each of the partners would have their 1 million. So we could be looking at exempt income if we had an unincorporated partnership that wouldn't exist if we had a company. So one of the most important provisions to think about is if you've got a number of individuals, are they better off transacting their real estate transactions in a company, or should they be transacting their real estate business transactions in an unincorporated partnership? If one of the partners in the partnership is a company, then obviously that company partner won't qualify for the real estate investment rule, whereas the individuals in the unincorporated partnership would. So you can have quite a mixture and a complex problem if you have natural person partners and company partners in a partnership. Foundations. We know that there are probably approaching 2,000 foundations in the UAE, and we know a lot of foundations are set up to own real estate. But those of us who have had a lot of experience with foundations know that foundations don't actually own the real estate generally. The real estate is owned by an underlying company. But if the foundation owned the real estate, and if an election was made by the foundation to be treated as an unincorporated partnership, and the foundation beneficiaries or the qualified recipients were natural persons, then number one, the natural persons would get the real estate investment rule, which would mean that potentially the profitability of the real estate transactions conducted by a foundation would be exempt. And potentially it would mean that if they're not exempt, they would each get the 1 million turnover test, and potentially up until December 2026, they might get the small business relief as well. So foundations are an interesting structure. Just do one more and then I'll stop for questions. Property trusts are going towards the complex structures, but what I want to impart here is that if a property trust is established correctly, the trust itself won't be a taxable entity, and the individual members of the property trust will be the taxable parties. But if the individual members of the property trust are natural persons, then in all probability they will qualify for the real estate investment rule if their circumstances qualify for it. And if they don't, then they will be looking at the million dirham or the 3 million dirham test.
Thank you, Dr. Wilson.